Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on again, Jim.
Drew, equity markets are at all-time highs right now. What's been the biggest driver of these high moves?
Yeah, the American markets and Canadian markets now moving to new all-time highs. It's been a very strong move right out of we had a brief down period at the beginning of October, so it's been roughly 2 months to move higher to get to these all-time highs. I think the biggest thing that you can look at that's happened over the last couple of months has been the optimism of getting a trade deal done with China. Now you can view that through many different ways. Again, it sort of seems like every 2 or 3 days we get a headline of some sort saying, phase one is almost done, and, we thought it was done a month ago, when it first got announced. So, is the market, continually pricing in, the same story over and over and over again and getting moved up to these new highs? I think that's a pessimistic way to look at it. I think the more optimistic way to look at it would be to say, that created so much uncertainty, and, over the last year and a half, and maybe pent-up demand, that now that maybe there is some level of hope or certainty going forward, some of these barriers to investment and barriers to business are being moved out of the way, allowing this market to move higher. But that to me, I think, has been maybe more top of mind for investor psychology. How an investor is feeling about the markets and the headlines that they're seeing in the daily news. I think the other aspect that is definitely not to be underaccounted for is the easing of central banks. When we were first selling off in October of this year, I had a lot of clients asking, should we be loading up on puts? Are we going to see the same sort of action that we saw in the equity markets last fall? And, my answer was we were coming at this market from a much different place. Last fall, we had central banks everywhere tightening. We had the Fed raising rates, raising all the way into the middle of December of last year as equity markets were selling off. This year, we've had 3 rate cuts from the Fed, and now we've got the not QE bond purchases of $60 billion a month. You've had the ECB go back to easy money. You've got easy money policies going on in China right now, and then, of course, the Bank of Japan, which has never gone away from easy money, continuing their easy money policies. So it's been a concerted effort of all the central banks this year that I think is a much different global picture than you had this time last year. So I think there's just a tremendous amount of stimulus that's being added to this market as well. So you've sort of got the headline ease with the U.S.-China trade war doing better. And then you've also got the central banks sort of having the back of the market that is coming together and pushing these equity markets to new all-time highs.
What other effects is this move higher having in equity markets? What's it causing?
I think the biggest thing to look at as we've sort of drifted higher is I don't want to use the word complacency of investors, because a term that, they're not paying attention to what's going on out there. But what we're seeing not only in equity markets but across all markets is just record low volatility. I think the VIX index today is, among the lowest it's been really in the last 2 years. We were last down at around these levels through the summer of, or the end of 2017, or most of 2017 for that matter. Very low volatility year. But incredibly low volatility in the equity markets, but we're also seeing that in currency markets, depending on whether it's a 3-month, 6-month vol average you're looking at, amongst the lowest that we've been at. In the last little while, we've seen gold volatility come off to the lowest level it's been at in about 6 months. So you're seeing this just reduction of volatility. And I think, one, that comes from the fact that, markets are moving higher, so there's maybe less need for some of this protection where people are willing to pay more for volatility. You're not seeing the price action that we used to see on some economic events, maybe because they are not as important as the two main sort of topics that I just outlined with, everybody seems to be fixated on what the latest trade headline is going to be, and that's hugely important across markets, or what central banks are doing, and that's hugely important across markets. So outside of that, other news seems to be having less of an impact on the markets day to day, reducing that volatility. And the other big aspect that I think is a symptom that's not going to go away is the need for yield. With interest rates being as low as they are globally and seemingly going to stay low after we ran the U.S. 10-year above 3% last year, very clear it wasn't going to stay there. We're much lower than that, under 2% this year. You have, big institutions that need yield. You have regular investors that need yield. So one of the ways that they've done that is they've gone around to all these different markets to sell volatility. So that is, selling call options on a position they have, selling put options as well. So that will compress the volatility of a market as well, given that you've got a lot more people trying to sell that product. Therefore, it's cheaper than it would be otherwise.
We'll have more with Drew Zimmerman right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, does this very low level of implied volatility mean investors are getting complacent?
Yeah, as I mentioned earlier, I don't think so. I don't think it's necessarily hey, let's just do this and forget about it sort of an attitude. I think it really is become more of an active strategy. So the opposite of complacency, where in a search for yield, investors of all sorts are selling premium, selling volatility in order to add yield to their portfolios in a number of different ways. So definitely not a complacent strategy. That one is much more active. You've got to be on top of it and managing it regularly. The overall drift lower as these price actions have come down, I also don't think is one of complacency. I mean, with equity markets really breaking out to new highs, I mean, the term everybody's throwing around is FOMO. You have to buy this market just because you don't know how far it can go, and especially these days, if you're a manager of any kind, you're running other people's money, you've got to keep up with the index. That's sort of how you're benchmarked. And this year especially, given the very low start after the sell-off last year, the year-to-date index numbers are very large. So people are aware of, having to sort of benchmark themselves to that index. And going into the end of the year, typically November and December are very strong months, very strong seasonality in those months. We get the so-called Santa Claus rally as we go into the end of the year. So you've got expectations from last year where people saw a severe sell-off, but I would consider that to be more a recency bias than the norm. So I think there's a lot of things sort of pushing this market, and I think we might just see it continue to move higher, but I wouldn't put the word complacency on it. I don't think that's quite the right term. But, as we do get up to these new all-time highs and keep marching higher, it definitely does, I think, do people justice to sort of have their antenna up a little bit to start seeing what's happening in the market, looking for signs, not producing signs where there aren't any. I think is a key thing. There's people that always want to be bearish, can find something wrong with any sort of a market, but I think this market's got a lot of strong signs. I think the recent strength in the Russell 200 in the U.S., that's the small cap index, I think that's showing a good amount of strength. There's some other things I'd like to see that show more strength. But again, to come back to your question, I don't think it's complacency. I think it could get to that point, but not at this moment.
We'll have more with Drew Zimmerman right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, what do you see as the best opportunities to take advantage of this market high situation?
Yeah, I think, as we've been talking about throughout this, one of the symptoms of this, or one of the trade-offs on this, has been this record low volatility. So I know it's always the old saying, buy low, sell high, that sort of thing. But I really am looking across the board at lots of different assets and saying, we've got, whether that's 6-month low, 2-year low, among decade low implied volatility levels. So I want to buy volatility. If everybody else is selling it, there's some value, I think, in buying it. And to me, buying volatility is sort of like buying insurance, buying car insurance, buying fire insurance. Except if you're just going to be paying it out, on a regular building for fire insurance, for example, you're always going to be paying it out, and maybe you collect on it. The good thing about our markets is I get to look around and I get to find a building that is in a high lightning zone that is covered with dead branches and tinder and all that sort of thing, and buy fire insurance on that building. Again, you have to buy the insurance before the fire actually starts, because then the insurance goes through the roof. But I think that's the opportunity that is presenting itself right now. So when I look around across a lot of markets, I see 2, maybe 3 key markets that I really like right now. One is the gold market. February gold are trading at about 1460 right now. I think that if we break down through the 1450 level, there could be a significant price move. There's massive speculative long positioning still in the gold market. So if it was going to break down through 1450, I can buy lower strike puts, again, at very cheap levels because the implied volatility is so low. I can get the big price move in my favor, as well as if we got a big price move on a break of strong support, that big price move is going to increase the volatility of that market as well. So by owning the volatility and getting the price direction right, I'm winning on two fronts. And because the volatility is already so compressed, I'm not losing a lot of decay if I'm out a month or two in my options. So I really like that market. I think the same thing is setting up in the Canadian dollar market right here at 75 cents. December Canada is trading at 75.30 right now. 75 has been a very strong level of support in the Canadian dollar over the last several months. I think if that level were to break, then again, you've got the probability, or the possibility, I should say, of a larger move in the price that should increase the volatility to some degree. You're able to buy those puts under 75 cents for a bargain because implied volatility is so low right now. You can get a good price move, possibly a volatility move as well. And both of those markets I really like because I'm seeing other things that tell me that they're quite possibly going to break. Both of them almost trade like currencies. So to me, the fact that we had the U.S. dollar break out to 1.5-month highs today tells me that there's going to be more pressure on both the Canadian dollar and on gold. The fact that the Japanese yen, which has had a very strong correlation to gold, has just broke down to 6-month lows today. That's telling me that it could possibly be leading where gold is going to go because of what's going on in global macro. So I really like those two markets. And then on the other side, the call option side is above the crude market. I think this crude market has really been sort of stuck at around 58.5. I think if it were to break higher on, again, this global economy doing better, equity markets moving to new highs, if that were to continue, I think there's a good run in the upside of crude still. And again, buying cheap volatility on that could be a good way to play it.
Are there any other markets you're trading in right now?
Well, all of those markets that I just mentioned are probably my biggest positions right now. Again, I've been more staying away from the equity market. I tend to be focused outside of the equity market until I start to see some issues with it. My thought there is most of my clients have an equity portfolio that will capture the upside in equities. I'm going to do more to try and capture some of the downside risk if there is that coming in equities. And then when equities are moving higher, I want to be in other markets to try and create value there. So some of my biggest positions right now are in the gold market, the short gold side of things. I'm long of oil, have been for a little while now. Still think that's got a strong possibility of breaking higher. I've got a position on in Canada. It's not overly large, but again, I still like the possibility of Canada breaking down through 75. So those are my three key markets right now. I've also got a toe in the water in some of the other commodities to see if we could see the commodity space do better overall. So that's a very small position in the long side of the corn market. Looking for that to do better. Again, just general commodity trends there. Also, on the weather front, with natural gas down at $2.50, it's really near the lowest levels it's been over the last couple of years. So I've got a position to be bullish of natural gas. That's if we start to see some colder weather come up here in the next couple of months as we go through the winter. That'll be a very weather-driven play, but again, smaller on those sides of things. But all in all, really starting to look at the commodity space in a bigger picture, just how cheap it is, and then cheap, and especially cheap compared to stocks, but cheap overall. And then also trying to put another cheap asset, which I think is this volatility play, on top of it. So if we got two cheap plays in one market, I think my risk comes down dramatically, and the upside is pretty dramatic as well.
Drew, thank you so much for chatting with us.
Thanks for having me on, Jim. Appreciate it.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. If you have any questions for Drew or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.